Welcome to Objective 3 in Unit 1 of Accounting 3310. We've already started this objective and now we're going to take a look at journal entries that match up with the analysis of transactions that we've done in Objective 2. As I work through these PowerPoints to get to slide 19 in order to start this, let's go ahead and talk about my landing point. As we take a look at a conventional journal entry, it's a way to capture the information in a very compact form about a business transaction, and it uses conventions that convey meaning. So it is really important to be very, very fussy about writing these journal entries. The order in which the accounts are written is important, and the columns in which the numbers are written are important. Here's our initial conventional form for recording a general journal entry. First of all, a journal entry has a single date because it's one event, and then connected with that date are all of the accounts that have changed in that transaction on that date. So the first transaction here reads that we have the account of cash being affected, and its effect is in the debit column of $1 million. Since we know cash is an asset account, a debit with respect to an asset is an increase in an asset, so we know that this company received $1 million. The second line is paid in capital, which is an owner's equity account. That's associated with a credit. It's on the right, which emphasizes that it's a credit. And we know that an owner's equity account associated with a credit is an increase in owner's equity. So this says that we have an investor who increased his or her ownership interest by contributing $1 million of cash to the company. The second row is a completely different journal entry, but notice we just have the same parts, the accounts, the debit column, the credit column. So here we have a building on the first line. It's a debit of $100,000. Buildings are assets. A debit associated with an asset is an increase in an asset. So this is an increase in building. The second row is note payable. That's a liability account. It is in the credit column, and a credit associated with a liability is an increase in a liability. So this company purchased a building on account and owes a mortgage on that building. Okay. The next question here, as we do these journal entries, is how do you know what accounts to use? Well, a company will have a chart of accounts so that within the company they will consistently use exactly the same account for any particular item. So if one company is using buildings, they will keep using buildings. Another company might use the word facilities or might use the word plant, and that's perfectly all right. You can have different account titles that are synonyms of each other, but within a single company there should be consistency in the account titles used. Here's what a chart of accounts might look like, in which we have an account title that's a meaningful name, and then an account number that increases the efficiency of the system if you can just enter the number rather than having to type out a very long name. For each of the transactions that we've looked at in Objective 2, we have a journal entry form now that displays that information. Here's our purchase of the building with cash in a journal entry form. Let's go to the next. Here is the sale of a building. Now notice the difference here. Cash is on the first line and the information is on the left. So we know it's an increase in cash. The company is receiving cash and decreasing a building. So this one says we sold the building for cash, while the previous one means that we received a building and paid cash for it. So the order in the columns are supremely important here. Here's our building that we did not pay cash for but instead have a mortgage payable. Notice that we've replaced on that second line cash for mortgage payable. They're both credits, One said we paid cash for the building. This says we have an increase in a liability of mortgage payable of $100,000 for the building. And a decrease in cash and an increase in a liability are both credits. Here's our compound entry, and this is the conventional format. In many electronic systems today, there probably is not a requirement that all the debits be listed first and then all of the credits. But it does make it much clearer and much easier to verify that debits are equal to credits if you follow that convention of listing all the debits in a row and then all of the credits in a row. Let's go on to the next one. Here's our borrowing of funds. It's an increase in cash. We know that because the cash account has its number in the debit column, which is an increase for an asset. The notes payable is a liability account. Its number is in the credit column on the right, so that we know that we have an increase in a liability. Here's the conventional way we'll see repaying debt. Interest is omitted here for simplicity, but we see when a liability is going down, it's a debit, and it's listed in the first row and in the column on the left. So that says, just by putting note payable and $100,000 in the left column, we're saying that we are repaying the note. The liability is going down. And here we're repaying it with the most usual item, with cash. So we have a cash decrease. It's a credit to cash. Let's go on to the next item. Here is owners investing in the company. Notice here cash is the increase, so it's on the left in the debit column. In the next item, we have dividends declared. This is a return of funds to owners. So we've got the decrease in cash. It's on the second row, and it's in the right column, letting us know it's a credit to cash or a decrease to cash. Dividends declared is the account name for dividends. Now we're on to our customer transactions. Here, if we have a cash customer, the business receives cash and recognizes the increase in owner's equity, which is a credit, so it's on the right. If we have accounts receivable instead of getting cash, notice that the accounts receivable here has replaced cash in the first line. That $100,000 is in the debit column. It's an increase in the asset of accounts receivable. If we have a prepayment, we have an increase in cash, that's a debit to cash, and a liability in which we owe the customer providing goods and services. That's a credit to a liability, is an increase in liability. Here's the conventional journal entry form when we are providing goods and services to a customer who prepaid. There's no additional cash at this time. Instead, we're providing the goods and services. This is when you actually get on the plane. The airplane earns its revenue and decreases air traffic liability, which is the specific name of an unearned revenue account for an airline. For the expense entries, here's a traditional journal entry form in which we have the expense first. A debit to an expense means we've got a decrease in owner's equity. When we use up assets in a business, it's a decrease to owner's equity. The cash here decreases. It's a credit to cash. That says a decrease to an asset. More complicated expense transactions happen when we first buy an asset and then use it up. That's what's happening here. So we have an exchange of assets here. The one that increases is inventory. The one that decreases is cash. Then we actually use up the inventory by handing it over to a customer. We've got a decrease in the asset of inventory and an expense, a decrease in owner's equity. Here is purchasing inventory on account. So instead of having cash going down, we have a liability increasing. Notice that a credit is a decrease to an asset, increase to a liability, increase to owner's equity. So when we paid with cash, it was a credit to cash. When we owe on it, it's a credit to accounts payable. Inventory in both cases go up. Here's paying off our accounts payable. It's the same format as paying those notes payable before. The liability goes down and we're decreasing our cash. When we sell inventory, we have a decrease in the inventory and we've got a expense of cost of merchandise sold. Here's a different form of resource purchased, prepaid insurance. That's an asset that increases when we buy the insurance. The cash decreases when we buy it. So here's our journal entry form for purchasing the insurance. When we use up the insurance, when that month of coverage is over, we're going to decrease the resource. Decrease in an asset is a credit, and our insurance expense occurs because we have a resource that's been used up. That's a debit that decreases owner's equity. We also have expenses when we have wear and tear on long-term assets that we use over many periods. Here's the purchase of the equipment, that's trading of assets. Then when we use the equipment during a period, we record that wear and tear as depreciation expense. That's a decrease to owner's equity and a decrease in the value of the asset. I have put the decrease in equipment directly here, but it certainly is more conventional to put it in a second account called accumulated depreciation equipment rather than decreasing the asset account itself. Either one is going to be correct, although what you're going to see in most information systems is going to be that accumulated depreciation account. We've gone through now all of the kind of sample basic entries that we examined in Objective 2, and we've seen these items now in journal entry form. As you become more and more familiar and comfortable with this form, you will be able to look at a journal entry and immediately read off what is happening in it. In the meantime, while you're still taking a look at a journal entry to figure out what it says, remember that the key here is to identify what element the account is from, asset, liability, or owner's equity, and then associate it with whether the number's in a debit or credit column to know whether that element has increased or decreased. Thank you.